Hi traders, how are we all doing today? Hopefully doing very well, not getting melted down by the Fitch news on the US. Morning guys, how you doing?
Good morning. What news is that? Sorry, I've been away the whole morning.
Didn't you see it last night? You're joking, isn't it?
What?
The US getting downgraded by Fitch.
Oh, sorry. I thought there was something. I thought there was something new this morning.
No. Just the stuff last night.
All right.
Came out. Yeah, you can breathe easy.
How are you,
Ryan?
you
all right? Yeah, I'm good, mate.
Yeah, all good, mate. All good, mate. I had the really wrong timing to sit in front of my PC when it all happened. So I covered a lot of my positions, and the market doesn't seem risk cares a little bit, but the dollar doesn't care much.
No. We'll have obviously talk about that in greater detail. What it all means. Lots of doom headlines being thrown around last night right after the action, and sometimes it pays not to get sucked into those. But anyway, we shall talk about that shortly. We'll start off with getting through all the other headlines first. China has asked some banks to reduce or delay its dollar buying, according to Reuters sources over in China there. They have been at the request of the state, been in and selling dollars to halt the weakening yuan. Now they want them to hold off or reduce some of their dollar buying through natural trading, part of their business, just to also help with that as well. I'm not sure what it's going to do to things. You can't exactly tell banks to stop doing their business, but China is China, and what they say often goes. For the dollar yuan, it's not done a huge amount. We are still seeing it drifting higher, so obviously that's not working for the moment, but no huge moves yet over that news. The Finance Ministry has extended tax breaks for small businesses until December 2027. So finally got some finer detail over the tinkering that they're continuing to do over there. Bank of Japan minutes were out overnight. Lots of comments from the individuals, although we don't really know their names, but we can guess. One member said that they must avoid as much as possible a spike in interest rates caused from the prospects of exit from easy policy. So talking about an exit there. Members shared the view of no need to make operational tweaks to YCC at this point. One member said they must consider reviewing YCC at an early stage to avoid big rate volatility upon a future exit from easy policy. A few members said that when the bank were to review YCC, it must be mindful of the risk that doing so could be seen by markets as a move towards monetary tightening. Many members said it would be appropriate to sustain monetary easing to support changes seen in corporate wage and price setting behaviour. Note that many members, not all members. One member sees it as premature to shift policy at a time when companies are becoming more keen to boost wages and investment. Another member said the chance that the BOJ is underestimating the sustainability of price rises cannot be ruled out. And many members said risks to inflation were skewed to the upside for the time being. So, picking through the bones of all that, there's quite an uptick in talk about exits, using the term exits, being mindful, looking at the risks, making sure that the market doesn't get too far ahead of itself. But it's still, another inch towards exit being the main part of the conversation at the Bank of Japan. It's another subtle shift, but they also seem to be doing it while being almost scared of doing it. I would say they are very, aware what volatility it may cause. So they're going to be moving to an exit with some trepidation, which we already suspected they would be doing. But still, it's little language changes, little comments coming in. Many members becoming several members becoming, one, and that sort of thing. the shift is underway, as we well know. Going to be a long, slow, drawn-out process, as we know, but might be a slow-moving snowball, but it's a snowball nonetheless. Now, one of those members was out after BOJ's Uchida, saying that we will continue with easing patiently, which is the new keyword, not persistently. The BOJ is a long way from raising negative rate. The goal of sustainable inflation is not in sight yet, and inflation expectations are showing signs of re-accelerating. If economic and price conditions remain roughly unchanged, don't expect interest rates to rise sharply. Currently not expecting to raise the YCC cap further. Anything to pick out of that lot, Kay?
Yeah, well, we've been saying it. You've repeated it again today as well. That's it. We're on the move. Uchida is one of the architects of. Let me kill my smoke just a second. Uchida is one of the architects of the YCC and this whole monetary policy thing. He's probably going to be one of the last ones to cling on to everything. The thing is, he is a deputy governor, so he has big saying things, and as we've seen Ueda already commenting the way he did, as you say, it's going to be a long process. They will intervene in the JGB market if the yields move too high. And as we've said, it's probably into the next BOJ. We are going, if not at 1%, probably going to be somewhere around 75 or 80 BPs or so. But that's about it, right? We can't really say too much more about this right now. But it's, as we've been saying for weeks, if not months, they will be going on the move. Change is there. And now we're looking at the speed of things. If they surprise anywhere, that's going to be for September. So that's still a month and a half away from the next meeting, right?
Yeah, agreed. I mean, I can't see them doing anything even in September now. Maybe some language changes, but yeah, I don't think they're going to be doing anything with the YCC anytime soon, unless the data, really continues and inflation continues to move higher. But if they did go in September, that would signal a big shift, really, wouldn't it? Moving the YCC 2 meetings on the trot.
Yeah, but their official rate is still at minus 10 BPs, right?
Yeah.
And I mean, come on, they can put it at 0 or at a quarter, at perhaps in the whole process. But they should do something about it, right? I mean, it's a bit ridiculous to keep it there right now. Well, I mean, I think we may be ready for a little bit of a shift there. I was just checking. The next meeting is on the results are on the 22nd of September, so that's even more than a month and a half. In between, yeah, they're not going to do anything in between meetings. Just one reminder is at the end of this month we are having the Jackson Hole, and that's usually an intermediate mini central bank meeting, as we've seen in the past. There could be some announcement changing, but talks about what the market may or may not expect.
Yeah, exactly. Well pointed out. Something to keep us going through the summer, at least, anyway. Right, coming into some of the data, there was some Kiwi data out overnight, some jobs data, quarterly jobs data, if I can find it. There we go. Unemployment change there coming in at 1% versus 0.6 prior. Just looking at the unemployment rate, that ticked up to 3.6%, higher than expected and last quarter. But that looks to be partly due to a rise in the participation rate to 7.4%, more people coming into the market. Labour costs, something the Fed has been watching particularly closely on their side, as mentioned by Powell last week, and we got the data this week. Labour costs, quarterly stuff there, not as high as expected, but still a jump over last month and a slight miss and lower year on year for that number there as well. Coming over to some of the PMIs as well. Switzerland with a bit of a shocker this morning, joining in the rest of the manufacturing doldrums. 38.5 versus 44 expected and 44.9 previously. Not a big number. I look at an awful lot. Not the biggest economy in the world, but it is adding to the trend that we're seeing in manufacturing at the moment. Now that was bucked a tiny bit over in the US of A, because yesterday we obviously got the ISM and the final S&P Global number. The S&P Global number coming in unchanged versus the flash number there, so no change there. Canada, a little bit of improvement as well, 49.6 versus 48.9 expected, so better than expected, but still a negative. Then we've got the ISM data as well, and that was pretty much, it was a bit mixed. Okay, the headline number came down softer than expected, but it was a gain over last month. Same with prices. They rose a tiny bit or less in contraction, but not as much as expected. New orders, that ticked up. Employment, that looked worse. But overall, if you take the main numbers, it was soft, but not as soft as last month. A lot of people saying that maybe we might be at the bottom for these numbers, particularly in the US. Doesn't mean we're going to massively rocket into expansion, but the first step in things like this is stop falling. So that's how that data was taken yesterday. JOLTS number as well, you can see there, another drop lower on that one. But the market seems to be brushing off this JOLTS data as not something that's really important these days. But it is what it is. It does potentially close the gap between the amount of positions available and obviously the number of people looking for work and getting work. So it's used as a bit of a measure for whether the labour market is tightening up and whether there are issues, i.e. firms not advertising work anymore because A, they can't afford to take on new people, or they haven't got the business to take on new people. So that's what these numbers are used for in the main. Coming into some of the other data, or rather comments as well, we had Fed's Goolsbee talking after the data, saying that the JOLTS data looks consistent with a strong labour market moving to a more balanced phase. For him, recent FOMC decisions have been close calls as the Fed tries to manage its transition. The golden path of getting inflation down without a major recession is a tight line, but so far, so good. Fed's Bostic, who's been a bit more dovish of late, says he's not expecting a rate hike to be necessary in September. Doesn't see a rate cut until the second half of 2024 at the earliest. The economy is evolving in a way that's consistent with an orderly slowing. Just as you can see there as well, or if I can find it, oil news, the API saw a record draw in stocks, which gave oil a lift up. But according to that as well, the US has not taken up another round of offers. They are sort of tendering out to replace stuff they sold from the SPR, but apparently they've knocked all those offers back. Which is quite funny because Zero Hedge said last night, obviously $65 was too cheap, so they'd rather wait for $130 before they start buying it up. But anyway, a big draw in oil there, as mentioned, gave crude a little bit of a kick, pretty much up to my tech level I've been watching, which I'll show you shortly. And now to potentially what was the big news coming in late last night, just as a lot of people over here were getting into bed. I was certainly in bed anyway when I saw that news. The US has been downgraded from AAA to AA+ by Fitch, citing fiscal worries, fiscal sustainability. A lot of people started jumping up and down that this was going to be the same as when the S&P cut the US the same way from AAA to AA. Back in 2011. It's not the same. We're in a different time. Everything is pretty much different at the moment. you may not want to argue the points that S&P raised about fiscal sustainability, given debt levels. We all know about that, how bad those are over there. But in terms of market reaction, so far it's been pretty tepid. Certainly no one's running to the exit doors. Now, some of this you need to take in context. Okay, as mentioned, we're not in 2011. We're 12 years from that, so things are different then. Another point is that usually if you get a big reaction, it's because a lot of firms will only invest, or their investment parameters will only allow AAA rated assets, i.e. countries that have AAA rating. So if a country loses its AAA, then that can force some firms to get rid of those assets because they're not allowed in the basket. So that can cause a bit of a sell-off. What it can also cause is the market trusting the sustainability of a country, which then can put pressure on bond rates, because if you feel that a country is not as secure or is facing problems, then investors will demand a higher risk to hold those government bonds. As you can see, we're not doing anything major in bond yields in the US. Stocks as well, not being kicked in the nuts too much. We have had a little knock off the highs, but again, nothing huge. So I think we need to see what the US does with it when they come in a fully open market. It'll be interesting whether we see some downside in stocks, and if indeed the dip buyers come running back in to take it all the way back to the highs. But it's not the doom and gloom that a lot in the market, or a lot of market commentators were making it out to be last night. Some were saying it's going to be as bad as 2011 when stock markets got cratered over it. What I do think is going to happen is we're probably going to see just a little bit of uncertainty. We're already seeing it now. We're probably going to see a little bit more just while the market sorts itself out, decides what it wants to do. But be very careful thinking this is the end of the world as we know it, and to sell everything, stocks and whatnot. This may not be the breakout of this trend. Your input, guys. Stel, what do you make of it?
Of the whole debt downgrade and how stocks and bonds are reacting?
Yeah.
I don't think it's there will obviously be a reaction to it because, like you said, institutional investors or pension funds, whoever, they need to hold certain quality assets or collateral, and they will then need to rebalance because of the downgrade. But I think this is a short-term thing, and really, in the grand scheme of things, I don't think anything changes in the way the US can borrow or its ability to borrow. We're going to need to see a lot worse things happening for this to become an issue. So at the moment, I see this nothing but a very temporary blip, and this is actually what the markets are telling us, right? Look at 10-year. It spiked up a little bit yesterday. It's kind of flat today. So the market is saying meh, and stocks also, yes, we're down a little bit today, but again, if you zoom out more than say a couple of weeks, it's the S&P, Nasdaq, we are still on a very clear uptrend. Could this be the beginning of a downtrend? Yeah, of course it could, but I don't think I don't see any technical evidence yet that we have seen a top. Even this news is not able to give like a proper breakdown of any sort. So if you look at the S&P chart, we're still above the recent lows, which are around 45.30. I know it's close, but this is the first level that there you go, 45.25 to 30 or so. That's really the first range that we need to break, and we haven't even managed to break that yet. So to answer your question, I don't see any real consequence or effect of this yet. What are you showing us? You showing us something?
Yeah, hello, I'm here, sorry.
Oh, yeah, no problem.
Yeah, just to give a bit of context before I bring Kay in, here's the list. This is from Wiki, and this is just the S&P, but they're all pretty much the same. You can see the amount of AAA countries that we've got in the world. not a huge amount. And the point I mentioned in the chat room earlier is that no one's going to be rushing out of the US to park in a lot of these countries. They're not going to be piling into Liechtenstein or Luxembourg or the Netherlands and that sort of thing. So the effect is I would say at the moment it's going to be minimum. You can never say never, of course, and that's why it's important to see what the US does with all this news when they get in later on today. If they don't sell off stocks, dollar, buy yields, sell bonds, we're probably going to go back to highs and probably then carry on through the highs and everything's back to normal. But I think we just need to get over that hump before we can make a full decision. Kay, what are your thoughts on all this downgrade stuff?
Exactamundo, what you guys have said. Well, it's a good chart. This peaks. That's something that should hold that 45, 25, 30. I sold a little early in the morning and bought them back on that support, and then we'll see what happens. It's over to the US to tell us if they really will get nervous about it or not. Well, no, I'm still a tad short because also because of the levels that I was already watching before, but I will only push more buttons if it goes below that support. I also would expect a reaction from the Fed to show their support to the US Treasury probably after Yellen's reaction. And lastly, it's Fitch. I think if one would put an order of importance, I guess Moody's, S&P, and then Fitch would be the right order. If Moody's would start to change, then I think there would be more panic on board. So that's it. For the rest, I completely agree with what you guys say. We have to wait for the reaction, and it is so far a storm in a glass of water.
Yeah, exactly. And speaking of Yellen, she did obviously strongly disagree with the ratings decision, and said that the downgrade is arbitrary and outdated, and that Biden is committed to fiscal sustainability. Blah 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 blah. Right. So that gives you that. And yeah, I think you're right. See what the Fed have to say about it. Though they haven't exactly rushed out the door to say anything, have they?
Yeah, they couldn't yesterday because it was after their close, I reckon. But then I think I've got the FOMC page open, but it's probably either the FOMC or the Federal Reserve of New York who is going to publish something. But I do expect something to come out at the New York Open. Yeah, and that's and I also had an interesting read because I don't know everything about it, but somebody wrote something about if you look at the criteria that Fitch used and why they would downgrade somebody, none of those criteria actually worked. If you look at the actual data, none of it actually works. None of the reasons for a downgrade were actually met. Only like one out of 3 or 4 or so were only met.
Yeah, well, they've still got a bad rep, the ratings agency, after what happened over the GFC and the banking crisis and all that. Lots of countries not happy about the downgrades and stuff. But yeah, that was a whole historical bum fight we don't need to bring up here. I'm in the same boat as Kay. Well, I actually sold it last night. I did manage to catch the main move in there, but I jumped in at 62, 45, 62. Just thought I'll keep some, put some in the pocket, just because I thought there might be a bit of a follow-through reaction when Europe came in. Thus we've had, and yeah, we're down to this support area, bit of a zone, bit of a wide zone from here down to 45s, 45, 16, but you can cut it up into different levels as well. But you can see it's a bit of a traffic area. It also goes back quite a way as well. You can't really see it. You'd have to do your own chart squawking or watching, but that is a bit of an area if you take it back to that period there, 2021, 2022's, just a bit of a traffic zone, as we like to call them. So I've sliced and diced my trade down as well. I'm going to be looking at tightening the stop, I think, because if we don't get any further downside when the Yanks come in, I'm going to be chucking that in, I think, and just take what money I've got and running. Dollar yen, I was umming and ahhing last night whether to jump in a bit of a short because I wasn't sure what the risk reaction would be to the news. But in the end, I ended up biting the bullet, jumping in 142.70s and a little bit at 143s, which again I've sliced. I actually missed this move down to the 25 area. So you can see technically it's not worried. We've bounced off this area here as well. It was a bit of a point on the way up, and then we got the break, then we held it, and then we made up, and technically that's exactly what you want to see. The level's holding as support, and that's what we've done. So gonna keep a close eye on this. Again, I might knock a bit more out if we get another move down to that level, but I think it's all going to be on the clock and what the US have to say about things. Another trade I'm in, and a lot of our chat room have been in, was buying dollar CAD down here. I'm still in the trade. I've added a little bit on the break of 133 just to see if this has got some legs, but we are banging ahead on my next level. We got up here around 33.16, 17. Again, technically it did what it wanted to do. I tweeted yesterday while we were trying to get through here, get through 133, that it was finding it a bit of a tough nut. We needed to hold 132.60s to keep it in the game, and we did that overnight as well. So that's led to a higher move now. So the trend is still ongoing for this one. The next resistance I've got on my tea leaves is up against this trend line and around about the 133.40 area, which is a bit of one of those on-off lines, not one you'd probably trade, but one of those ones you just keep on in case something happens when the price gets there. So that's what I'm looking at as the next topside level. If we can get above this 16-17 area, I'll probably take a bit of profit on there and yank my stops up further if we go through it. And then we're talking about 134 all over again. Main support for me is still going to be around 132.60, but want to see how this 130 continues to hold up and whether it builds enough support to give us a bit of a springboard higher for that one. Euro sterling, I'm beginning to wonder if I'm being a bit greedy waiting for another move down here. We keep coming down to this sort of 50s area and holding. We've had 3 cracks at it now. The first move had a little poke under, but then we've held this 50 area again, just a bit of an on-off level, and we've bounced back up to 86s. So yeah, I'm wondering. I've been waiting to get another move to the low 85s, even down to 85, to add back into my longs. As I say, just wondering if I've been a little bit too greedy. Again, if we get down here in another swifter move, I'll be less inclined to have a go down there because it will mean a 4th knock on the door and coming back fairly quickly, which in my mind potentially signals that we're going to get a bit of a break under. Then I might get me 85s, who knows? But yeah, in the meantime,
83.5 is a target, mate.
What?
83 to 83.5 is still the target.
Well, you could have that when I've got out my longs at 88.
That's okay. It's fine by me.
Yeah. Yeah, I mean, I don't know what I'm going to do if we did break through that 85. I don't know if I'd hold it. I mean, I'll be buying it down here as well. If we got back down there to these, particularly to these lows, I'd probably be buying it even earlier, down at 84. So I don't know. I'll see what happens. If we do get a move down here, I might just hoover up little bits all the way down to these prior lows if it gets there and see what it wants to do. It's a good range trade. You can see how the range has been over the years. It's a very good range trade, and this is a big old level down here. I know we were watching it and trading it the last time we came down here.
Yep.
So yeah, I had
I'm
longs
going to
in
be
here.
looking to buy when we get close to the the 83s. So, but patience.
Yeah, exactly. I mean, I was jumping in here when we got these moves and ran it all the way up to 86 last year, I think it was, and then I got out over the summer at 86. I think 86.24 because it was doing nothing. It was doing absolutely nothing all last summer, and it was just costing me money to keep the trade. And then I got in pretty much at the same level later in the year and rode it higher. So where was it? No, it was in here, wasn't it? I can't remember. In here and in here through the summer, we got through there. Yeah, so good range player, this one, but you've got to have some patience for it. You've got to have some big patience for this one. If you're going to trade it, you need to sit and watch the market like a hawk, and hope it goes your way. Kay, do you want to have a whiz around?
Yes, sir. I think we have to look at risk today, right? So
Yep.
let's share a few of those yen pairs. And but you've already covered the S&P. It's around that zone, right? That 45.30, 45.25 zone. I think, and we have seen it. So there's two reasons I would say why the dollar yen is coming down, and one is that we tagged the 78.6 of this. Hang on. One is that we tagged the 78.6. We also ran into, overshot just a little bit this wedge or channel or whatever you want to call it. And then we saw a bit of a setback. It was an area that we were watching very closely in our room yesterday, and I think I even mentioned it on the Flow Show. So now we're coming back again for two reasons. One is technical. We did have a strong move higher from after the BOJ. Time for a breather, and now I think we will have to see what the US will wants to do with this. There are a few intermediate levels now that we should watch. The first one is the low 142s. Then we have one in the low 141s. I guess yen is volatile enough to watch it this wide. And the top side is clear. Anywhere 143, 35, 50. Yeah, 35. Yeah, it's actually 35, 50, 35, 55. If that goes, then that's probably the gateway to 145 again. And really, I guess the US is going to decide what they want to do with their own dollar this afternoon. Keep an eye on the yields, because the yen is going to still be a follower of fashion on that one. Even if we call it a storm in a teacup or a glass of water, as we say in the European continent, actually a downgrade, as we've already been saying. If people need to sell US bonds, in theory, that could actually push the yields higher before we see then a return in a second phase. But first of all, it could be a one that drags yields actually a bit higher, because people may be selling bonds. But again, we haven't seen this move so far. We will wait for the US to tell us what to do. Okay, I would not front run too much of these events. So yen crosses will and should be starting to look interesting, right? We have this double top now around 158. It's clearer on the short term, but I wanted to show this longer term as well on the euro yen. You know, the 155, right, is a big level somewhere here, a big long-term trend line as well coming in there. It's still going to be the pivot, in my opinion, as we saw ahead into the Bank of Japan. We saw a big drop below, and then when after the Bank of Japan, we stalled around there for a while and then shot through. So 155 is still a pivot enough, and keep an eye on if that 158 would go. Then we have a bit of an extension here of this last leg lower in 2014, 2015, which could take us all the way into the 160s. And if the 158 would give way, I find this euro yen still holding very well, considering the possibility that the ECB is at the end of the line as well. And I've got the impression that if we push higher in that dollar yen, we are going to hear much more from the Suzukis or Matsunos or Kandas of this world trying to stop the rot. But We are trend followers, data watchers, so we have to respect those levels. And then what I was meant on the shorter term, we are seeing this 158, right? 1, 2, 3 attempts. It's really building into an important level up there, and this is your 155 again. In the intermediate, we have a small level if we would push up into the mid 159s. The ones that are getting very interesting here is Aussie yen, because that has sort of respected the 78.6, bit of a trend line overshoot and then back down. We are currently trading on this intermediate support in the 93.75, 93.90 zone. So keep an eye on that for the end of the day. And I also think that everything is going to be linked today when the US walk in. So risk is going to be a factor. If risk does better this afternoon, these levels in the yen pairs are probably going to hold, and we may be in for a retest of the higher zones. If the US decides that what is happening, or they are not convinced by Yellen or the Fed or so, if they come out with a reaction, then risk could actually get a knock on the head, and you have to watch what's happening in the equity markets, and I'd say especially in the S&P on that 45, 30, 25 zone, and that's going to be a driver for most of those risk pairs this afternoon. If you look at the Kiwi yen, there's a bit of activity there where we stopped yesterday again. There's a bit of activity there in this 88.20 to 88.60 zone, and we're also coming back to an intermediate support area. So it's been very volatile. So that's another of the risk pairs that you want to keep an eye on, especially with those data in Kiwi land and in Aussie land perhaps not being as bright as we may like or come to expect. Sterling yen is another one that could be, and that's going to be one that is going to move tomorrow, I reckon. Tomorrow is going to be a day for the sterling. We will probably cover the sterling tomorrow, but already this for a risk 184, 183 and a quarter top side. For the longer term, it's actually much lower than here. But in the intermediate, there's a bit of activity around this 181, 180 and a quarter zone. That could be already enough for a pivot to trade off. If we see any further deterioration in risk, we could go and have a look at 181, for instance, on the sterling yen, and it's a bit of a traffic zone, right? So that for the main yen pairs. Ali, I saw your question, but I reckon we are going to cover the Bank of England tomorrow, Ryan, right?
Yeah, that's right, mate. We'll get into that.
Okay. Yeah. Just let me have a look at risk, okay? And because risk is on the move. Talking about this dollar mix. Dollar mix saw a pretty decent move higher on this risk of move. Despite numbers that are holding up well. So again, I reiterate, watch just above 17 on this dollar mix. We've again tried it this morning. Again, we've capped it around 16.99 this time. It is a pretty important zone, right? If we start to get through there and the market doesn't like risk, we can expect a bit of a bigger move higher. Euromex, ditto. That's your first zone here in the high 1860s, but then the more important around 18.75, 1880, and then the big one around 19. So those are the levels that you watch if risk would continue to deteriorate. If everything is dying down again, then I reckon the MEX is still going to be a currency that longer term investors want to hold. Dollar rand is bit of a mystery. The rand got really slapped around the ears, and we are well back above 18 again, back into the channel, above even the lower end of the channel. I don't know where my top line has gone, but props on the daily. If we get any setbacks into the 18, I suspect that people will try to catch a knife down there. And that's it. You covered oil, right? And stuff.
Yeah, I was going to do a quick look at oil.
All right, yeah, go ahead. That's it for me today.
Yeah, thank you very much, mate. Yeah, right, a couple of things first as I grab the screen back, just quickly. Can you see that okay?
Yeah.
Yeah, cool.
Good.
Right, so first thing first, our non-farm payrolls competition is open. You can get the link in the chat there. Jump on the tweet there, put your guess in, and you can win a free month on the ForexAnalytix platform. So get guessing for there. 200k is expected on Friday. What do you think your number will be? Just to answer Mike's question, do I think dollar yen is still a buy on a correction? Yes, but that was my thought before this news about the downgrade. So you have to take that into account. At the moment, it's looking like a dip buy because the market has done exactly that against the nearest decent tech level. But as Kay said, you need to watch the whole risk picture. This could be one of these situations where we've had big news. The market's had a little move on it. The market may have a further move on it. But if the market doesn't see it as a big problem, this is where you then get a quick move up, and potentially we just walked right through that recent high, yesterday's high, because what happens is everyone's a bit nervous now down here. If those nerves mean nothing, what you do is you get all the people who sold it up here taking profit. Then you'll get all the dip buyers who were waiting for a decent dip. Now they've got confirmation they can get in on the dip, and then you get those jumping in as well. So you often get a more volatile move as a post reaction to the news, and that's usually, as I've often seen, it can take out the prior high, and then we keep on trucking, and it might be, 144 the next stop in that particular move. So yes, is it still a dip buy? Potentially, but I'm not going to put my arse on the line and say it is going to be until I see what the Yanks want to do. I will only react to what the price does, not exactly to what I think it may do or should do. I'm sure if it comes to pass that we don't get a further move down on the US coming in, I'm going to be smashing that button to get myself out of that trade as quick as possible, as will lots of other people, no doubt. So be careful of the volatility. Yeah.
Ryan, can you just stick to that picture, because it's nice and interesting. I think if you, it's one to trade both ends of the story if you want to risk a little bit, because if you look at this underside, that blue thing in the low of 142s, your stop is pretty clear. If you if you are a bottom fisher, if it goes through 141.90 figure, you better get out. And if you're if on the other side you say that there's more to do, or you think 143.5, that 78.6 is has put in a top, your stop is pretty clear as well. Once it flies through 143.60, 65, you should be out. So this is potentially for day traders an interesting little zone to trade.
Yeah, exactly, very much so. Levels for everything, keep your risk tight as well. Okay, quick look at oil before we finish up for today, because as mentioned, I was looking at this for a move up to the top of this zone. Been looking at that for a while, the 82.50. Oh, let's get it in focus. Let's go a bit wider, might help. So this zone up here, the old fib, really been a strong support and resistance point. I didn't tap it last night because I didn't want to jump into a trade overnight while I was in bed. I like to watch these sort of scalps off the big figures, but it's done it already. Although the dip so far hasn't been anything really significant. As you can see, we didn't quite get up there, just got up to about the 40s, 82.40s. So it's the level shown up for now. We're trying to get below and hold below this 82 level. So it's all in the mix of what happens here. Maybe I'll tap another one up there. What I'll probably do is, if I do a short against this level, I'll probably do a stop reverse at somewhere through 83.50, because I think if it breaks, it's going to go. But in the meanwhile, and as Kay was saying with dollar yen, you've got clearly defined levels to trade against, and that's all you want when you're trading. And you can keep your risk pretty tight against it. If you're wrong, you don't need to burn the house down to be wrong, and you live to fight another trade. So that's my thought on oil. Watch out for the EIA stuff later, the proper US inventory figures, because that could change the picture around as well. Crude stocks expecting a draw of 1.367 million, but obviously now we've had that minus 15 million last night off the API. The market's probably going to be expecting a bit more, but the API to the EIA stuff is a bit like ADP to NFP. It's not a linear straight line correlation in the numbers. So, you know, you could get a build in the EIA and then you see this coming down anyway. Right, Still, you got anything you want to add before we close up shop, or you're going to save yourself for tomorrow? No, he's gone. I bet his lunch is here again.
Yeah,
He's already gone.
probably.
All right.
It's a shame he's gone already, because I was wondering what was for lunch today.
Oh, we're going to be ribbing him for ages on that one. Right, so keep an eye day to day. ADP 1:15 UK time, 189k expected from that whopping 497k last month. Nothing else on the data front apart from NBA. So keep an eye on that. Watch that US Open today. It's going to be potentially very important. Thank you all for coming to the Flow Show. Cheers, Kay.
Cheers, guys.
See you all tomorrow for the Bank of England. Whoopee, can't wait. See you later.